There are 7 learning outcome statements in Chapter 8. To understand financial markets and why they exist is somewhat of a review from Chapter 1. Describe the key components of the U.S. financial system. Identify basic characteristics and features of preferred stock. Learn how to value preferred stock. And the truth is, that is using our perpetuity valuation formula that we learned in Chapter 6. Identify the basic characteristics and features of common stock. Learn to value common stock. And then learn how to calculate a stock's expected rate of return and to explicitly identify the 2 components of that expected return, the dividend yield and the capital gains yield on the stock. There are several definitions in Chapter 8 that are very important, different types of preferred stock and the features they provide, different voting opportunities for the common stockholders, and things like that. There are 2 items not given in the textbook that I explore rather briefly. They are short selling and buying on margin. And any investor should be aware that buying on margin could be a possibility and understand what short selling is. So I'll draw your attention to those items not in the textbook. In Chapter 8, we're going to learn about the stock market and how to value and calculate the return on preferred and common stock. In Chapter 1, we talked briefly about financial markets and why they exist, and how the primary purpose is to transfer the savings from the households who have accumulated savings over to the businesses who need the savings to finance investments. So the financial markets provide a way for businesses to finance expansion and for households to invest and get a return on their savings. Remember, financial assets are claims on the productive capacity of real assets and the cash flows that they will produce. And in the primary market, that's where the investment bankers help firms issue new securities for the first time. And then it's in the secondary market where those previously issued securities trade from investor to investor. We measure the performance of the stock market through what are called stock indices. These are broad measures of stock price movement, basically showing us if the value of the overall stock market is going up or down, and how fast, perhaps percentage-wise, those values are changing. The Dow Jones Industrial Average is perhaps still the best known measure of stock market performance. The Dow Jones, or the Dow as it's often called, the Dow Jones Industrial Average consists of 30 large industrial stocks. It changes from time to time. Within the last couple of years, Travelers, which you recognize as the umbrella in the commercial, the insurance company, and the dog buries the bone in the backyard and all that, that's the Travelers company. And of course Cisco, the tech company, are recent additions. Others over the last few years have been added as well from time to time. If you think about the composition of the Dow now, it's not only large companies that manufacture products, chemicals, things like that, like DuPont, but Walmart has been on the Dow for the last 14 years. McDonald's been on for over 25 years now. So there are some that we don't typically think about as necessarily industrial stocks, but they are all large, well-known, highly valuable companies. The value of the Dow Jones Industrial Average, it's called what is a price-weighted average. The price of the 30 stocks are simply added together, and then they are divided by what is called the divisor, and you can look up that divisor every day in the Wall Street Journal. So you add up the price of those 30 stocks and divide by that divisor, which effectively is going to multiply the sum of those prices by a factor of somewhere around 8, about 8 times. So the index value might be around 14,000 or something like that. You add up those prices and you'll get something along the line of 1,800 or something like that. You've got to divide by that divisor, 0.132, to actually get the index value. The divisor allows for changing of the composition of the index and stock splits and things like that that affect the stock price without really affecting the value. So those stock prices or the actual stocks themselves can change and the divisors change to try to keep the index from being unaffected by simple changes in the composition. What's supposed to change the index value is the actual change in the value of the 30 stocks in the index. So there are a lot of mostly household names, but again, not all what you would think about as necessarily industrial stocks, but all large and for the most part household names, companies that are very well known and very valuable. Now, the S&P 500 index is a market value weighted index of 500 large companies versus the NASDAQ index, which is often called the tech-heavy NASDAQ because of the large number of tech stocks in it. And there are over 3,000 NASDAQ stocks in the NASDAQ Composite Index. It's also a market value weighted index. So these are affected by the stocks that have a greater market value having a greater effect on the index value, as opposed to the Dow, the stocks with the highest prices have the highest index on the value, on the index value. The NASDAQ is an index number that was indexed to be worth 100 back in 1971, and so you can see based upon a $100 investment back then how it has grown over time. The NASDAQ 100 is obviously much smaller than the NASDAQ Composite. It's 100 of the largest non-financial stocks out of that NASDAQ Composite. And in 1994 it was reset to an index value of 125, so you can measure how a $125 investment would have grown since 1994 if you just look at its current index value. Now let's think about how stocks are issued and traded. You'll hear about an initial public offering in the stock markets quite often. A public offering is simply where individuals and institutional investors at large have the opportunity to purchase a particular stock issue. A private placement, on the other hand, is where securities are issued or sold to a limited number of investors, which is called a private placement because the transaction basically is private between the issuer and that investor or a small number of investors. The term money market refers to short-term securities having a maturity of 1 year or less. These are typically fairly liquid and certainly short-term, so of fairly low risk. The term money market mutual fund refers to these short-term securities that are held in the form of an investment company or a mutual fund, which is the pool of funds from many different investors managed together, and that those funds are then invested in the short-term money market securities. The capital market, on the other hand, is everything with a maturity longer than a year, which would include stocks that do not have a maturity. Trading takes place in stocks in one of two places, either through an organized security exchange where trading takes place on the premises, or in the over-the-counter market, which is everything except the organized exchanges, and that is typically a dealer or computer network, or physically going into a dealer's office and, quote, trading over the counter with the dealer. But much of that is electronic now. We're actually buying or selling from the dealer. In the organized security exchanges, the broker represents the buyer or the seller, and the brokers come together and actually consummate the exchange of cash for securities on the exchange floor. In the over-the-counter market, you're buying or selling to a security dealer. Now the NASDAQ has more securities than the New York Stock Exchange, but the NYSE still accounts for about half of the equity dollar volume, even though it does have far fewer securities. So that speaks to the value, larger value of the firms that are listed on the New York Stock Exchange. Although the gap is closing, the NASDAQ is gaining volume against the NYSE. Now, a couple of things I think you should be familiar with that are not addressed in the textbook are the idea of buying on margin and short selling. When you buy on margin, you borrow a portion of the purchase price to purchase securities and you borrow from your broker. Your broker will let you borrow up to, but no more than 50% of the purchase price of the securities, meaning that you must put up at least half of the purchase price. By borrowing, this creates a levered position which will magnify, multiply, or lever your gains or your losses. The leverage effect is inversely related to the amount of money you put up. Another way to think about that is it must be directly related to the amount you borrow. The more you borrow, the more leverage you have. Or the smaller percentage you invest, the more leverage you have. So your gains or losses will be multiplied by 1 over the percent you invest. So we'll do an example to illustrate how that leverage effect works. But we'll define short selling first, and that is where you actually sell something that is not yours. You borrow securities through your broker. You actually borrow those securities from your broker's other customers, and you sell them short. You short sell them by borrowing them and selling them. Your broker holds the proceeds. You also post margin or collateral before you can short sell. So your broker arranges the short sale for you. You borrow the securities and sell them, and the broker holds the proceeds. You're hoping you can buy those stocks back at a lower price and return them through your broker so that their other customer gets their stock back in their account. So what you were hoping you were able to do is to sell the stock when its price was high. It wasn't yours, so you borrowed it and sold it when you thought its price was high, and then you go buy it back later at a lower price, and you will have profited from the difference because you bought low and you sold high, which is what we always want to do, but you just did it in the reverse order. You sold it first at what you hoped was a high price, hoping to buy it back at a low price and return the shares that you borrowed, thus profiting from the difference. So in example 8.1, we look at buying on margin. You borrow half the money, which is the maximum, to buy 100 shares of stock at $50 per share. And then the price goes up to $60 per share. Well, certainly you're going to profit because it is your stock, but your percentage return is going to be even greater because you get the entire $10 per share increase and you only put up half the money. So we're going to base our return on how much we invested. We bought 100 shares at $50 per share. That's a $5,000 investment. We put up half the money though, so we really only invested $2,500, and that is what we'll calculate our percentage return on. When the stock price goes up to $60 per share, our 100 shares are now worth $6,000. We borrowed $2,500. When the share price goes up, my loan amount stays the same, $2,500. So at the point where my stock is now worth $6,000, I could pay off the $2,500 loan and walk away with my equity of $3,500. So I invested $2,500, my half of the $5,000 in stock. So I invested $2,500 and it is now worth $3,500. So my percentage return is a $1,000 profit on a $2,500 investment, and that's a 40% return. The stock price went from $50 up to $60. It grew $10 above the $50 price I paid, so it increased by 20%. My return was 40% because I only put up half the money. My leverage factor was 1 over the half that I put up, or 2 times. So the stock price went up 20%. My return was 40%, twice that of the percentage change in the stock price. Because I put up only half the money, my return is twice the percentage change in the stock itself. Now, short selling. You short common stock at $50 and it climbs to $60. Well, that's not what you want it to happen. because you sell it for $50 and then you've got to turn around and buy it so you can replace the borrowed shares, but you now have to pay this higher $60 price. So you're going to lose, in that case, $10 per share. If you sold it at 50 and you're lucky and it falls down to 40, you get to buy it at 40 and replace it, and you then made $10 per share. So the point is that when you short sell, you will lose when the share price goes up and you have to pay a higher price. You will gain when the stock price falls and you get to buy and replace the borrowed shares at a lower price than you had shorted them. You short them at 50, you're going to lose if you have to buy them back at 60. You'll gain if you buy them back at 40. Now, there's no leverage here for the short selling. It's just reversing the way in which you profit or you lose. So you gain when the share price falls after you short it. You lose if the share price rises, but think about it as dollar for dollar, not a multiplicative or leverage effect like when you borrowed to buy on margin. Let's talk briefly about the regulation of financial markets. In the United States, the primary regulatory body is the Securities and Exchange Commission. Now, they don't have control over every type of security exchange, but for large public issues that take place all throughout the United States, they do govern. For small transactions within a single state, the SEC does not govern those transactions. But for most things we observe on a public basis, the SEC would regulate, and they regulate the securities exchanges that we know about. Shelf registration is something you should be familiar with because the registration process can be lengthy. We have to put together audited financial statements and register with the SEC, and that can take several months to get that done. And we might have a period of time where it's really attractive for us to issue stock. And if it's at that point that we make the decision to issue the stock, then the registration process might not have even begun, and it might take us months and months to get the securities registered before we can issue them, and we will have missed a golden opportunity to issue stock at an opportune time. So shelf registration lets us pre-register securities and issue them over the following 2-year period. You don't have to issue them all at once. You have this 2-year window on which the stock can, quote, set on the shelf, and you can pull it off the shelf when you need to and issue it bit by bit over the following 2-year period. So that is shelf registration. It's pre-registering securities and getting a 2-year window to issue the stock. The margin requirement, however, is actually set by the Federal Reserve Bank. You have to put up at least 50% of the equity to be able to buy on margin, so you can borrow no more than 1/2. And the Federal Reserve can change this margin requirement as one way that it can control the level of economic activity. So if it wants to speed up economic activity, it could lower the margin requirement, let you borrow more. If it wanted to slow down economic activity, it could do away with buying on margin and require you to put up 100% of the money yourself. But it's a tool that the Federal Reserve does not use too often. Now let's start with the basic characteristics, features, the pricing and return calculations of preferred stock. Preferred stock is a hybrid security, kind of like a hybrid engine is part gas, part electric, or a crop could be a hybrid of 2 different crops that have been blended together, cross-pollinated, or what have you, in that preferred stock has features of both debt and equity. The characteristics of preferred stock that are similar to debt is that the cash flows are reasonably determinable, kind of like the coupon payments on a bond. When the bond is issued, you know what coupon payment has been promised to you over the life of that bond. When the preferred stock is issued, you know what preferred dividend has been promised you over the life of that preferred stock. The characteristics of preferred stock that are similar to equity are that it is equity truly, it has no maturity, the dividends paid on preferred stock are not tax deductible, and if the firm does not pay the promised dividends on preferred stock, then the preferred stockholders cannot force the firm into bankruptcy because dividends are not an obligation of the company until the board declares them. So the expectation of preferred dividends could be made, but it's not enforceable unless the board declares those preferred dividends each time we expect them to pay the preferred dividend. If you look at the stock quotes, for example, in the Wall Street Journal, you will typically see just one common stock quote for most companies, but you might see multiple preferred stock quotes because there may be different issues of preferred stock that have different features or different percentages of stated dividends and things like that. So it's common to see multiple classes of preferred stock and typically only one class of common stock. Some firms do have more than one share of common stock, but it's more than one class of common stock, but it's common to see multiple classes of preferred stock. We know preferred stock gets its name because it has a preference. It comes before common stock in both the claim on dividends and the claim on assets in case the firm is liquidated. So preferred comes before common stockholders, and that's what gives the preference, and that's what makes preferred stock safer than common stock. However, the preferred does come after the debt holders. So the debt holders have a priority claim, the common stockholders have that residual claim on what's left over. The preferred stock would come in between the two. So preferred is safer than common and riskier than debt. Some common features of preferred stock. One, the preferred dividends may be cumulative. If preferred stock is cumulative, which is common, if a preferred dividend is skipped in 1 year, it has to be made up or caught up in future years before common stock dividends can be paid. So when preferred stock is cumulative, you can't skip a dividend in 1 year without catching it up. Otherwise, you could never pay common dividends. You have to catch up the missed preferred dividends if the preferred stock is cumulative before common stock dividends can be paid. Preferred stock may have protective provisions that will limit the firm in some way if the preferred dividends are not paid. So if the preferred dividends are not paid for so many periods, then the preferred stockholders may get some voting rights. There may be further ability to restrict the rights of the common stockholders if the firm is not paying the preferred stockholders what they were promised. And then convertible preferred is the option where the preferred stockholder has the option or the right to convert their preferred stock into some predetermined number of shares of common stock. Let's think about a situation where convertible preferred stock could be converted into, say, 4 shares of common stock. And suppose our preferred stock is selling at $100 per share, and our common stock is selling at $20 per share. Well, in that case, I would prefer to hang on to my preferred shares. I would not convert it into common stock because that way I would get 4 shares worth $20 per share. My preferred stock is worth more, so I'll keep it. Typically, the preferred stock will just produce those preferred dividends every quarter, and you don't expect a lot of capital appreciation for preferred stock. But if it's convertible, what's going to happen if this common stock starts to go up and it goes up to, say, $30 per share? In that case, your preferred stock is 100, the common stock is worth 30, you can convert your preferred into 4 shares of common, which is worth $120. Well, then you would want to convert it. You would trade the $100 share of preferred for the $120 worth of common stock. So in that case, you would prefer to convert your preferred share into the 4 shares of common stock. But the truth is, you wouldn't really have to do that because everybody could observe that this preferred share could be converted into 4 shares of common worth 120. So now your preferred stock would automatically go up to be worth $120. So the conversion privilege is going to cause your preferred stock to behave more like common stock. As soon as it is advantageous for you to convert, then your preferred stock will now be acting like 4 shares of common stock, even if you don't go ahead and convert it into the common stock. So the conversion privilege, the convertible preferred stock, will continue to be worth the preferred value until the common stock starts to perform really well and it's advantageous for you to convert, or at least to, for everybody to observe that you could convert. Then that preferred stock will now behave like 4 shares of common stock. So you get to participate in the good fortunes of the company as opposed to just continuing to receive your preferred dividends if your preferred stock is convertible. Now, preferred stock is equity, so it has no maturity, but that does not mean that it's going to stay outstanding forever. There are a couple of reasons why that might be the case, that the preferred stock might actually be retired and not have an infinite maturity. One is that the preferred stock might be callable. That gives the issuing firm the right, but not the obligation. It gives the issuing firm the right or the option to repurchase the preferred stock at some stated price over some specified time. So if preferred stock is issued and it's callable, at some point the issuer can simply repurchase it at that stated price, and it's not going to stay outstanding forever if the issuer exercises that option, but they don't have to. Another thing that can shorten or establish a finite life on preferred stock is what's called a sinking fund provision. And this is where the firm sets aside periodic payments to either call in shares if they're callable or purchase them on the open market. So if a firm issues preferred stock, they might set up a sinking fund, and each year over the next 10 years they might repurchase 10% of that preferred stock. So that would set a life on the entire issue of 10 years. After the first year they buy back 10%, after the second year they buy back another 10%, and so on until they've repurchased all that stock over 10 years. So that will certainly set a finite life on that preferred stock. So that's 2 reasons why the preferred stock may not stay outstanding forever. Now, valuing preferred stock is fairly simple. It's just our perpetuity valuation formula from Chapter 6. In Chapter 6, we said the present value of a perpetuity was the payment divided by the discount rate. Here in Chapter 8, we're going to say the price of preferred stock is the preferred dividend divided by the discount rate. That is just our perpetuity valuation formula using the term dividend instead of payment, and the RPS being the required return on the preferred stock, establishing the price on the preferred stock. As is true of any security, the value is the sum of the present values of the future cash flows you expect to receive from that security, and for preferred stock that was a perpetuity stream of dividends discounted at the required rate of return. So in example 8.2 here, we're going to value preferred stock. The preferred dividend is often expressed as some percentage of the par value. So our stock in this example has a preferred dividend that is 5% of the stock's par value, which is $100. So 5% of $100 means the preferred dividend is $5 per year, and our required rate of return is 7%. So to price this preferred stock, we'll take our $5 dividend and divide by the 7% required rate of return, and we'll set a value of $71.43 on the preferred stock. Another way to think about this is if you pay $71.43 for the stock and you require a 7% return, 7% multiplied by the $71.43 you invest is that $5 dividend. So the $5 dividend will give you a 7% return on your $71.43 investment. Certainly if you pay any price above $71.43, you'll not be receiving that 7% return that you require. So in part B of this example, what if we saw that stock actually selling for $105? What kind of return would you receive if you paid the $105 market price for that stock? Well, of course, you were only willing to pay $71.43 because that would give you your 7% return. If you had to pay the market price of $105, that's well above what you were willing to pay. You certainly will not get a 7% return if you pay this price. In fact, we'll see your return will actually be the $5 dividend each year divided by that $105 price you have to pay. And if you paid $105, you get a $5 return each year. That's only a 4.76% return. So if you paid the $71.43 price, you'd get a 7% return. If you had to pay the $105 price, you would only be getting a 4.76% return. Certainly, paying the higher price resulted in a lower return. Prices and percentage returns are always inversely related, everything else equal. Now let's look at the characteristics of common stock. As we know, common stock is a means to provide investors with limited liability. Although they still are owners of the firm, their liability is limited to their investment in the stock. One of the risks, major risks posed by the investment in common stock is that the common stockholders have the residual claim or the residual interest on the firm. They get what is left over after the debt holders are paid and after the preferred stockholders are paid. Then if anything is left, the common stockholders get it. Of course, the benefit is if the stock performs really well, then the debt holders and preferred stockholders probably only get a stated return, and the common stockholders might get a lot of earnings if the stock is performing really well. So in good times, the common stockholders make out well. In the bad times, they're probably the last ones to get paid and probably suffer the most. So it's that risk-return trade-off. If you want to get the higher return, invest in common stock, but you might get burned and have negative returns more often than you might under debt or preferred. So the claim on assets, the common stockholders are the residual claimants. They come last upon liquidation, but they do own the firm, so the common stockholders have voting rights. They get to elect the members of the board of directors. And then if there's a merger or some other significant change, then the common stockholders will get to vote on those changes. You don't have to necessarily own the stock in order to have the voting rights, because a stockholder can give you their proxy, which is their right to vote. They can give it to someone else to vote at the shareholders meeting for them. Whenever you own stock in a publicly traded company, you will receive an invitation to their shareholders meeting. You'll get a ticket in the mail, but oftentimes it's accompanied with a proxy card, which they hope you will sign and send back to them, and management is happy to vote your shares for you. So there's a good chance that management likes the board because the board hired that management. Then they're probably going to take your proxy and vote your shares to keep the board they like, who will keep them employed as a manager inside that firm. So you can exercise your own right to vote if you want to attend the shareholders meeting and vote your shares. If you don't send the proxy in, then your shares will not be voted. Voting for the members of the board of directors takes place in two different methods. Majority voting is where the seats are voted on one at a time. So if you own a majority of the shares and we elect the first seat on the board, then you will cast a majority of the shares on that seat and you'll win that seat. Then voting moves to the next chair and you will cast a majority of the shares on that seat and you'll win it too. So if you have a majority of the shares, you will win all of the seats on the board under majority voting. Under cumulative voting, voting takes place for all the seats at the same time, and you're able to accumulate all your votes and put them on the seats that you wish to win. So if you have a minority interest in the shares of the shares, you still might be able to win some seats on the board by taking all your votes and putting them on a small number of seats you can actually win. So a minority interest will not control the board, but they might be able to win some seats on the board under cumulative voting. The preemptive right is something that protects the existing shareholders from what is called dilution. It prevents the board from being able to issue a bunch of new shares to some new stockholders who could then dilute your ownership and mean you would have less control of the company because these newly issued shares would go to someone the board wanted them to be issued to. The preemptive right allows you, the current shareholder, to maintain your proportionate interest in the firm when new shares are issued. So if you own 10% of the current shares and the firm issues new stock, you have the first right to buy 10% of the newly issued shares. That means you will own 10% of the old shares and 10% of the new shares, so you will own 10% of the new total. Your ownership percentage will have stayed the same if you exercise your preemptive right. If you did not have that preemptive right and you did not get to buy any of the new shares, your percentage ownership would now be less than the 10% that it was. So again, this prevents dilution. You have to exercise your preemptive right in order to maintain your percentage ownership, and you will have to pay for those newly issued shares. So you do have the right to buy the shares, but you do have to pay for those newly issued shares to ensure that your ownership percentage is not diluted. In valuing common stock, again, the intrinsic value of any investment equals the present value of the future cash flows that will be received from that investment. Well, with common stock, we've got an infinitely long cash flow stream because the common stock has no maturity. We also have dividends that are going to change as earnings change and payout policies change and things like that. If we make some simplifying assumptions, though, we come up with a nice, neat, finite model here that will value the common stock for us. It says if we take the next dividend, not a dividend just paid today, but the next dividend one period later, and we divide by the required return minus the dividend growth rate, that will give us the price of the common stock. So the next dividend divided by the required return minus the dividend growth rate will value the common stock. This dividend growth rate G is also called the capital gains yield because it is the rate at which the share price will increase each period. This dividend discount model does require that our required return be greater than the growth rate. If that's not the case, then the dividends would be growing faster and faster than we discount them. So dividends far into the future will have grown really fast and be discounted relatively slowly, so the present value of each future dividend will be growing larger and larger and larger, and there's no end to that stream. So you have an infinitely long stream of dividends, each one worth more than the one before it, and so you would have an infinite value for the stock. But truthfully, the model would show you a negative value in that case. So the model blows up. Now, it just doesn't make sense to imagine that we would require a lower return from something that's growing really fast. So the model requires your required return has to be greater than the growth rate. So here is our model solved for the return on the stock. You can check that algebraically. This says the total return on the common stock is the sum of two components. This first component is that next dividend divided by today's price. This second component is that dividend growth rate, or the capital gains yield on the stock. If I buy the stock today at its current market price and I get a dividend, say 1 year from now, then this first term expresses my return that comes solely from that dividend that I get next year. So that is called the dividend yield. I pay this price today. 1 year from today I get this dividend. That is the portion of my return received over the course of the next year that came solely from that dividend. Plus, this is the rate at which I expect the share price to grow. That is called the capital gains yield. The sum of those two components gives me the total return on my stock investment. So some of my return comes in the form of income via the dividend. Some of my return comes from share price appreciation, that being the capital gains yield. Let's do an example. In example 8.3, we see that ABC Incorporated just paid a dividend of $2 per share. When we see that a dividend was just paid, that occurs up front at time 0. We will call that D0, the dividend just paid, the dividend paid at time 0. Dividends are expected to grow at a 4% rate. That is our growth rate. We will use that to calculate D1. We will also use that as our capital gains yield. If investors require an annual return of 12%, what should be the price of ABC's common stock? Since the model calls for D1, we'll calculate D1 first by taking that dividend just paid, the $2 dividend, and growing it at 4% to see that the next dividend will be $2.08. That is D1. We'll divide D1 by the required return minus the dividend growth rate. So that denominator is 8%, the required return in excess of the dividend growth rate, and that will give us a value of $26 on that stock. The reason we need D1 instead of D0 is D0 has already been paid, but furthermore, we would miss that first year's growth in the dividend if we didn't grow D0 into D1. So this dividend will be 4% larger when we get it a year from now than was the $2 dividend just paid. In part B here, we assume the same dividend and growth information, but we say, what if we actually paid $50 for this stock? We buy it today for the $50 price and we get D1, $2.08, 1 year from now, then what kind of return are we going to get? Plus, we're going to see share price appreciation of 4%. That is what our growth rate tells us. It's the capital gains yield, or the percentage change in the stock price. So if I pay this $50 price for the stock today, my dividend yield will be the $2.08 D1 expressed as a percentage of the $50 price that I paid. So my dividend yield is 4.16%. Plus, I get share price appreciation of 4% per year. So my total return on the stock, if I pay the $50 price for the stock, my total return will be 8.16%. This 4% capital gains yield, or rate at which the price of the stock goes up, is the same as that dividend growth rate, because at whatever rate your dividends grow, your stock price will grow at that same rate. It should come as no surprise, since we were only willing to pay $26 when we required our 12% return in the first part of example 8.3. If we required a 12% return, we established a $26 value on that stock. If we go pay the $50 market price of that stock, then we will only be getting an 8.16% return. Prices and percentage returns are always inversely related, everything else equal. So if I have to pay this higher price for the stock, my return will certainly be lower than it would have been if I could buy it for the $26 price and get my 12% return. What makes a stock price grow over time? Well, if the firm is able to generate some return on its equity investment, then the equity inside the firm is going to grow if they retain part of that equity that they generate. So for a share price to grow over time, in a book value sense anyway, They got to generate some net income on the equity investment and then retain part of it inside the firm. So to make a stock price grow faster, we need to do a better job generating net income on the equity that's been invested inside the firm, so to boost our return on equity, or retain more of the profits the stock does generate, retain more inside the firm, so that will result in more share price appreciation, or both. Generate more net income as a percentage of equity and retain more of the profits, then the share price will grow even faster. If we just continue to pay out all of our net income in the form of dividends, then our stockholders will be getting a dividend yield, but there's really no growth, and so the stock price may not grow. Their return will come solely in the form of dividends if all the earnings are paid out every year. In example 8.4, let's look at the capital gains yield and the total return a little more carefully. The stock sells for $10 per share. It's expected to pay a $1 dividend in 1 year. Dividends, and thus the price of the stock, are expected to grow at a 5% annual rate. In other words, the capital gains yield and the dividend growth rate are this 5% rate. So the stock sells for $10. It's expected to pay a $1 dividend in 1 year, and the share price will grow at 5%. So what is the price of the stock expected to be in 1 year? It's $10 today. We expect it to grow at a 5% annual rate. It will be 5% larger 1 year from now. So the $10 price will grow by 5% in 1 year. I expect the stock price to be 5% larger, or $10.50. In part B, I need to calculate the dividend yield. So if I buy the stock today for $10 and it pays a $1 dividend 1 year from now, then I'm getting a 10% return solely in the form of dividends. That next dividend, D1, as a percentage of my $10 stock investment, gives me a 10% dividend yield. That is my return that comes solely in the form of dividends over that first year. Thus, the total return on the stock will be the sum of this dividend yield plus that capital gains yield, which was given to be 5%. So the total return will be my 10% dividend yield plus my 5% capital gains yield, which would be 15% as the total return on the stock. That's the sum of the dividend yield and the capital gains yield is the total return on the stock. Now example 8.5, you purchased a stock today for $25 and in 1 year it pays a $1.25 dividend and then sells for $30 per share. We need to calculate the dividend yield, capital gains yield, and the total return. So the stock price up front is $25. In 1 year I get a $1.25 dividend and the stock price has gone up by $5. So I calculate the total return. The dividend yield first is the $1.25 dividend expressed as a percentage of the $25 investment I make. The dividend yield is 5%. In part B, we calculate the capital gains yield. The stock price goes from $25 to $30. It increases by $5 per share. It was $25 originally, so my $5 increase is 20% of my $25 investment. And then my total return will be the sum of the dividend yield and capital gains yield for a total return of 5% dividend yield plus 20% capital gains yield for a 25% total rate of return. Now for the concept reviews in Chapter 8, I encourage you to pause the lecture and go ahead and fill those in, see if you're thinking the same way that I am, and then continue the lecture as I complete those. The Dow Jones Industrial Average contains 30 very large stocks, and it is computed by summing up those 30 stock prices and dividing by what's known as the divisor. That divisor is a small number, something like 0.12 or something like that. So the index value around 12,000 or something like that could be many, many times the sum of those 30 stock prices. The S&P 500 index reflects the market value of 500 large companies, and the NASDAQ Composite Index reflects the value of over 3,000 stocks, and that NASDAQ index was normed to a value of 125 in 1994, so you can tell percentage-wise how far it's moved since 1994 when its value was 125. Cumulative preferred stock is entitled to dividends in arrears before common stock dividends may be paid. That means if preferred stock didn't get a dividend in one year, then it gets caught up in the subsequent years before common dividends are paid. While convertible preferred can be exchanged for a predetermined number of shares of common stock. So that allows preferred stockholders to participate in the good fortunes of the company, because if the common stock is performing really well, preferred stock may not do much, but if it's convertible and the common stock is growing in value, then the preferred stock will grow in value as well, because it can be exchanged into that predetermined number of shares of common stock. The formula to value preferred stock is simply the dividend divided by the required return, which will be expressed in percentage form. That's the perpetuity valuation formula from Chapter 6. And the formula for the return on preferred stock is the dividend divided by or expressed as a percentage of the price of the preferred stock. Common stockholders are said to have a residual claim on the income and the assets of the firm, because they tend to get paid last after the bondholders and after the preferred stockholders. But they do have voting rights, and the preemptive right is the one that allows the common stockholders to maintain their proportionate ownership interest in the firm. So if the board decides to issue new shares of common stock, that preemptive right allows the common stockholders the first right to maintain their same percentage ownership of the firm, because they get to buy that same percentage of newly issued shares, so their ownership percentage-wise is not diluted. Common stockholders have the right to vote at the corporation's annual meeting. They elect the board of directors. They would vote on mergers and other significant changes to the corporation. Granting somebody else the right to vote your shares is referred to as granting them proxy. And a lot of stockholders don't go to the annual meeting. They just sign their proxy card and let somebody else who's going to be at the meeting vote their shares. The constant dividend growth model says the price of common stock is that next dividend, D1, divided by the required return on the stock minus the growth rate, all of that in the denominator. For this model to work, the required return has to be greater than G. If not, then that denominator would be negative and the price would be negative. And that can't be because of limited liability. Also mathematically, the model just wouldn't work if R is not greater than G. That constant dividend growth model shows that the return on the stock can be divided into its two components. Those are called the dividend yield and the capital gains yield. The dividend yield is that next dividend divided by the price. Next dividend expressed as a percentage of the price is the dividend yield. And the growth rate in the dividends is the percentage change in the stock price, which is called the capital gains yield. The growth rate in dividends is the same as the capital gains yield, because if the dividends grow by some certain percentage, the stock's price will grow by that same percentage G. In Chapter 8, we learned about different features of preferred and common stock and some terminology related to those investments. We learned about the major stock indexes. We learned about buying on margin and short selling. And we learned that the common stock investments provide return to investors in two forms: the capital gains yield, or increase in stock price, and the dividend yield, which is the percentage return you receive from receiving dividends, often paid quarterly, on a stock investment. Now that you've completed the Chapter 8 lecture, you should complete the practice problems found in the rectangular boxes throughout the chapter in the course notes if you have not already done so. The solutions to those are found at the end of the chapter in your course notes. You should complete the supplemental homework practice problems at the end of the chapter in your course notes, and the solutions are found on iTunes U, where I use the document camera to work them out, or there's the PowerPoint file posted to Blackboard that shows you the answers to those problems. So work them first before you check the solutions. Attempt the blank Connect assignment on Blackboard before you do the online Connect assignment. Check the syllabus for the chapters covered and the due date of the Connect assignment, so you allow yourself sufficient time to complete that by the due date. And then come to class and we will go over the solutions to the Connect assignment, and you may ask any questions you would like. You should bring that blank Connect assignment because that is the one we will discuss in class. And if you want us to look at your individual Connect assignment, you should print off the one you took online or bring your laptop and we can access your answers and go over it with you during class. Begin preparing for the exam early. Compile your exam formula sheet as you go. And remember that we repost the Connect assignments for additional practice so that you can do each Connect assignment an unlimited number of times after it is due for additional practice. The numbers tend to change each time, so you can get additional practice using Connect by working the practice Connect assignment multiple times after the original assignment was due.